Tax is at an all-time high of 38% of GDP. As a result of last week's budget, an extra £26 billion has been raised. And that's on top of the amount of tax raised at the last budget. In terms of inheritance tax in particular, 153,000 estates are forecast to come into inheritance tax over the next few years as a result of the changes made at the last budget. And the forecast inheritance tax by 2030 is going to be £14 billion plus per year. I would strongly recommend that you take financial planning advice as a result of these changes. At least start the conversation with your advisor, with your family, as a result of these changes. There's a couple of important dates for your diary. April 2026 and April 2027 are when most of these tax changes are going to be implemented. So you have some time, but not a whole lot of time before you need to start taking action. And ultimately, that's what it's all about, taking action. Particularly with inheritance tax, taking action means you can reduce or even eliminate any inheritance tax payable by your beneficiaries. So how did we come into all this tax, all these record levels of tax? Well, really, Rachel Reeves, the Chancellor, summed it up quite nicely, didn't she, in the scene-setting speech over our cornflakes a few weeks ago, when she took us through a list of doom, really, of what's been going on in the country over the last 10 or 15 years before she came into power. So we had the credit crisis, we had the impact of Brexit, we had the pandemic, we had wars around the world, we've got a cost of living crisis. And the result of all of these different situations and problems meant that when Labour came into power last year, they were faced with a £40 billion black hole in the country's finances. And I suppose quite rightly, she looked to plug that gap, that black hole last year in the budget of last year, which meant the big increases of tax last year. She also brought in her strict fiscal rules last year so that by 2030 the country would be in a surplus in terms of our every day-to-day current account. So that was last year. Since then we've had nothing but bad news, really. Growth is running really low, forecast to be just 1% per year over the next few years. Inflation is still kind of sticky, it's still too high over target. We've got Trump coming in and causing tariffs all around the world, which caused a lot of chaos in the markets and politics. We've still got the wars raging. So as a result of all of these problems since last budget, the Chancellor was really priming us for more tax rises in the budget last week, and I guess she didn't disappoint. As I say, £26 billion raised in tax just last week. So it wasn't all bad news. There was a few opportunities as a result of the budget, and as I said, it's really starting the conversation, starting to take advice, starting to take action is the most important thing when you're looking at some of these tax changes. So I'm going to go through all the different taxes and as they apply to people in later life. Of course, there was a whole lot of other detail in the budget, but as best I can, I'm going to pick out the main taxes that apply to people in later life, and I'll also talk about some of the possible financial planning solutions around those tax changes. So let's start with income tax. As you'll have seen on the news, they froze the income tax thresholds for another 3 years up to 2031. And that's extended the freeze that the Conservatives brought out when they were in power. And by the way, this is by far and away the biggest tax revenue out of all of the changes that were made. So probably more than all the rest of them put together. So it basically means that as your income rises, your pensions, your pension income, your investment income, and your employment income, as they rise with inflation over time, it does mean that more and more people will be paying more and more income tax. Record levels of people paying a higher rate of tax. So on top of the freezing of the thresholds, they added 2% onto dividend tax. So for anyone with investment portfolios outside, the tax-free shelters, anyone with portfolios or shares, you'll be paying an extra 2% tax on your dividends from April 2026. In addition to that, anyone with building societies, bank accounts, savings accounts, or bonds, investment bonds within your portfolios, you'll be paying an extra 2% tax on your savings income, interest, from April 2027. And then for anybody with properties, investment properties, properties that you're renting out, there's going to be an extra 2% tax charge on your rental income, again from April 2027. So income tax by far and away resulted in the highest level of tax as part of that 26 billion. Planning around this, well, making sure that you use your allowances. They've reduced the allowances massively over the last few years, but there are some allowances, so make sure you use them. You've got your £500 dividends allowance. You've got your £1,000 interest allowance, obviously reduces to 500 once you become a higher rate taxpayer. So not much, but still available to you to use. If you are a husband and wife, make sure that you use both of your allowances, so split your income as best you can. Don't forget the good old-fashioned ISA, £20,000. Make sure that your investments or savings within an ISA are completely tax-free. I'll come on to the changes in ISAs in a moment. Investment bonds is becoming much more popular over the last couple of years. Investment bonds is just another type of tax wrapper where you can invest your portfolio, your investments within a bond. And the beauty of investment bonds are that they are non-income producing or non-gain producing. All of the portfolios is within the bond. So that means that you're not subject to this ongoing punitive taxes, income tax, capital gains within the bond. So it's becoming much more popular. There are taxes within the investment bond itself, but nowhere near as much tax as a higher rate taxpayer would pay on their dividends and their savings and their capital gains. So furthermore, the investment bonds are very flexible, so you can assign segments to family members, perhaps who are non-taxpayers or lower taxpayers in the future. You could wrap a tax wrap around it, perhaps for inheritance tax in the future. You could take a tax-free income from a bond. So very flexible. You're basically deferring the tax into the future. Very, very popular, especially if you're a higher rate taxpayer and you've already used your pensions and your ISA allowances. So that's basically income tax. I did want to touch on venture capital trusts. Although they would be considered a higher risk investment, they did change things slightly in the budget last week. They reduced the income tax refund that you get by investing into a VCT from 30% down to 20% from April of this year. It basically means if you invest, at the moment, if you invest £10,000 in a VCT, you get £3,000 off your income tax bill. That's being reduced to £2,000 from next year. They should be considered higher investment risk, so you have to go into it with your eyes open. But what they did mention during the budget is they're going to open up the investment horizon for VCTs to allow them to invest in bigger companies, more later stage companies. You're able to invest more now in a VCT, as in VCTs are allowed to invest more in smaller companies. And the result of that means VCTs are probably going to have much more of an investment choice, probably better returns and slightly lower risk. So the investment case for VCTs is actually quite strong now, despite perhaps annoyingly the reduction in the tax refund from 30 to 20% in April. So that's income tax. Let's move on to capital gains tax. They didn't make any changes last week, which was good. There was lots of rumours that they were going to increase the capital gains tax rate from up to aligning it with the income tax rate, which would have been a lot more tax. Obviously, they did change the tax rates last budget to 18% and 24% for higher rate taxpayers. really good was that they didn't change the rules on death. So currently, if you've got big gains in, say, a second home or a holiday home or an investment property or investment shares portfolio, there's no capital gains tax on death. Basically, the capital gains gets wiped out on death. So that remains, which was a very good benefit of the budget. There was lots of rumours that they were going to not have that, and the original cost was to remain. So that's good. Although you have to remember, look at all of your financial planning situation, looking at the inheritance tax, that kind of thing. There is still an allowance of £3,000 capital gains allowance. Again, it's a lot lower than it used to be, but still an available allowance that can be used on an annual basis. It can be used between husband and wife, so there's the spousal exemption between husband and wife on transferring capital. So that's good. And if you do have any losses brought forward from previous capital losses, they can be offset against any capital gains going forward. So that's capital gains. There was the change that I mentioned to savings. So the ISA has changed for under 65s, can now only invest £12,000 in a cash ISA, with the balance having to be in stocks and shares ISA. Again, that only applies to under 65s. A lot of the detail around that is still to be flushed out. We're getting a few queries around that, so that doesn't come in until April 2027. So we can there's a bit of time to plan around that, but there is the reduction in the cash ISA limit down to 12,000 for under 65s, although the full £20,000 ISA limit still remains for everybody, and for over 65s you can still invest in cash ISAs. I guess that's a general move to try and get people to invest more in stocks and shares, as opposed to having money on the sidelines in cash. The big change is really, if we're looking at over the course of the two budgets, is inheritance tax. One of the most significant changes in many years was the announcement last year that pensions, unused pensions, would form part of inheritance tax. And it means that it's really turned a lot of advice on its head. Previously we were advising people to stay in pensions for as long as possible, and that'd be the last place you take your money from. And they were really being used as a trust fund to transfer assets through the generations tax-free. Well, that's been changed on its head since April 2027, when unused pensions will form part of your estate for inheritance tax purposes. There are planning options around this. So firstly, if you're over 75 and you have an unused pension and you haven't taken your tax-free cash, I would strongly recommend that you really think about doing so. The overall tax rate on a pension over 75, if you're subject to inheritance tax and the income tax, would be upwards of 80%. So even if you took the tax-free cash and didn't do anything about it, you'd still be much better off than leaving the tax-free money in the pension for over 75s. Even if you're under 75, it's still worth having a look at your pension, start reviewing things from a holistic inheritance tax planning basis, and maybe better to get on with it even now, even if you're under 75. So a lot of the planning is around the tax-free lump sum and what to do with it. So you could take the tax-free lump sum, and by the way, they didn't change the tax-free cash. That was a big win really from the budget. There was a lot of rumours that they were going to reduce the tax-free lump sum from the 25% that it is now, or a maximum of 268,000, I should say. So they didn't tinker with that. So if you were to take the tax-free lump sum from the pension, which is from April 2027 going to be taxable, there's various things you can do from an inheritance tax point of view. You could obviously gift it outright to a beneficiary, which is probably the simplest strategy. And if you survive 7 years, then that gift would be outside your estate for inheritance tax purposes. Again, there was lots of rumours that they were going to extend that 7 years to 10, 15 or even 20 years. So it was a result that they kept it at only 7 years. And they also didn't change the taper relief purposes. So as long as you survive over 3 to 4 years, there's a tapering process, and any inheritance tax on that gift is reduced. So you gift outright. What tends to be more common is you gift into a trust, where you maintain control of get the money outside your estate, but maintain control of that money. That tends to be where you're gifting to grandchildren, minors, under 18s, or you perhaps might not completely trust your child's spouse and things like that. So you might want to just have control over that money still, and then you decide who gets the money and when out of the trust. There's lots of different types of trust that you can invest in. The main thing is to tell us what you need, whether it's access to an income, a tax-free income, or you still need access to capital, or whatever it is that you want. There's usually a trust for you, whether you've got fixed beneficiaries, whether you want to have discretion over your beneficiaries. There's a trust for you. So by taking the tax-free cash out of the pension, you could gift the money outright, gift the money into a trust. Other things you could do is use a business property relief investment. So basically last year they introduced a 1 million allowance, business property allowance, that is basically inheritance tax free after 2 years. So what's business property relief? Well, it's a government incentive that's been going on since 1975. Originally it was for family businesses to transfer businesses through the generations, tax free, but over the years it's kind of expanded into an incentive from the government for people to invest in assets that they want money to flow into. So things like fibre broadband, care homes, property lending, renewables like solar power and wave power and things like that, wind power. So wherever the government objectives are, there's an incentive for people to invest in those infrastructure assets. And so investment providers have built up portfolios of really well diversified assets that give you a pretty stable return, give you access to the capital when you need it, and as I say, benefit from this inheritance tax free after just 2 years and if held till death. So really good if you have a limited time scale, if you want to get things done quickly in 2 years, if you still want access to the money in case you perhaps have worried about care fees or other expenditure in retirement. It's still your investment, so you've still got the potential to grow your money over time. So very popular, becoming very mainstream. So don't be scared of business property relief. Just get in touch if you need questions or if you need more information on that. Whole of life family trust policies are a potential way of providing for a lump sum to pay for inheritance tax. One of the best solutions currently is by drawing down a pension, which we feel might be subject to inheritance tax in a couple of years. As long as you're, say, basic rate taxpayer, you could draw down an income from your pension on a regular basis. You could give that away regularly, and that would be exempt from inheritance tax immediately. Or you could pay it into a whole of life family trust policy, which is basically a life insurance policy in trust, which provides a lump sum in trust for your beneficiaries to pay some or all of the inheritance tax at the time. This is really important because a lot of people have inheritance tax problems because of property or it's going to be because they've got money in pensions. You have to pay the inheritance tax after 6 months of death. They've put the interest rate up at the last budget to 8% on late payments of inheritance tax. So it basically means that you really need to be paying off the inheritance tax. You need that money there and then from day one, and that's what this whole of life insurance family trust policy will do. Your beneficiaries get this lump sum from day one to pay some or all of the inheritance tax, and it just saves them having to fire sell a house or having to raise a loan or something like that when they need the money for the inheritance tax. So really worth it, really cost effective. You often have to have saved up to 100, 110, 120 to save up the amount of lump sum that you get from day one by taking out one of these policies. Remember, the spousal exemption still exists, so there's no inheritance tax to pay between husband and wife, so we're always talking about second death. So for pensions, it's important that you get your nomination forms completed so that on first death the pension transfers inheritance tax free to the survivor, and then we can start addressing inheritance tax for when there's only one surviving spouse left. They fix the thresholds, not just for income tax but also for inheritance tax as well. So thresholds fixed up until 2031 now. So you've got your £325,000 of inheritance tax allowance. That's been fixed since 2009, would you believe? It would be about £550,000 now if it was increased by inflation. So that's £325,000 fixed. 175,000 on the house is fixed. That's the extra allowance, the extra inheritance tax-free allowance you get on your house. And what this means is that over time, when property prices, investments, everything goes up in time, more and more people are going to be subject to inheritance tax. It used to be for the rich and wealthy. It's going to be much more of a mainstream problem now over the next few years. Quick mention on ISAs. What used to be an absolute no-brainer was ISAs. You'd save up all of your life, completely tax-free, and then you'd be subject to 40, or your beneficiaries would be subject to 40% tax on those ISAs when you pass away. So what was very popular was to invest in AIM ISAs, AIM shares within your ISA, which qualify for business property relief in the same way that I've just discussed, and that would have 100% inheritance tax relief after you passed away. They reduced that, unfortunately, to 50% relief at the last budget, so effectively the tax rate is 20% now on those ISAs, but still better than nothing. If you've got ISAs that are going to be subject to inheritance tax, still worth considering, even worth considering switching from the ISA to the business property relief investment schemes that I previously talked about, the ones with 100% relief. So even that's still worth considering. There is a general movement for growth. You perhaps wouldn't see it on the face of it, but the government do want more money to flow into startups, smaller companies, AIM shares, and so there has been a relaxing of the rules around what VCTs can invest in, as I said, and also institutional money, pension money. They're looking to invest more into these companies. So there could be an investment case as well for investing in smaller companies in the UK. And don't forget the mansion tax, the tax that's on homes over 2 million. Probably opens the door now for more tax on property in the future. So we'll just have to see how the practicalities of that play out over the next couple of years. That comes in April 2027. So I've rattled through all the taxes that I think are subject to of interest to people in later life. I would strongly recommend, as I said, to start talking about these things with your advisor, with your family, in order to plan around these significant changes, really, in some cases, especially with the pensions as part of inheritance tax. Start taking some decisions, perhaps start taking action to kind of reduce or even eliminate some of these taxes. If you need any help, please get in touch and book a meeting with ourselves. First meeting complimentary. It's really an exploratory meeting to get to know you and to see if we can make a meaningful difference to your situation. Thanks for tuning in, and we'll see you next time. Cheers. Bye.